If you run a home care agency and you've started setting up your systems the right way, there's something important you need to understand next. Because this is where a lot of agency owners get caught off guard. It's what I call the 250,000 trap. Many business owners assume if I'm under the $250,000, I don't need a balance sheet. But that's not always true. I'm an enrolled agent, a federally authorized tax professional with over 14 years of experience in tax and accounting, and I focus on helping home care agency owners understand their numbers and stay compliant. And one thing I've noticed is this: as businesses grow, their tax situation becomes more complex. But many owners are still operating with the same systems, the same habits, and the same financial visibility they had when they were much smaller. Here's where the confusion comes in. For S corporations, the IRS does not just look at your revenue, they also look at what your business owns. So even if your agency makes less than $250,000, if your business assets are over that threshold, you may still be required to report a balance sheet. For example, you could make $150,000 in revenue, but have business assets worth more than $300,000, like transport vehicles, equipment, or even property owned by the business. In that case, you may still be required to report a balance sheet. And the reverse is also true. You could have higher business revenue even without major assets and still be required to report a balance sheet. So this rule is not just based on one number. It's based on both your revenue and your business assets. And this is where many agency owners get blindsided because they're only tracking the revenue, but not what the business actually owns, owes, or is accumulating financially. Because your balance sheet is not just a tax requirement, it also helps show the financial health of your business. It shows what your business owns, what it owes, and how financially stable the business really is. And that information becomes very important as your business grows. For example, if you ever apply for funding, a business loan, or a line of credit, lenders will often want to see your balance sheet because they want to understand the financial position of your business. It also helps verify that your records are accurate, keeps your numbers organized, and gives you better financial visibility as your business grows. And when your records are clear and complete, you're in a much stronger position financially, operationally, and from a tax perspective. Now, here's another shift that starts happening around this stage. Tax strategy starts becoming more important, not aggressive strategies or risky shortcuts. I'm talking about proper planning, clean records, good entity structure, and understanding how business decisions affect your taxes. Because as your business grows, small mistakes become expensive mistakes. Now, let me be clear. Growth is a good thing. Making more money is not the problem. The problem is growing financially without upgrading your systems, your planning, and your financial visibility. Now, partnerships have slightly different rules, and we'll break those down in a separate video. But the key takeaway here is this: don't assume you're exempt just because you're under $250,000. Your financial system should be able to produce a balance sheet whether you think you need it or not. because when you do need it, it's not something you can easily recreate after the fact. And this is exactly why having a complete accounting system matters. Now that you understand the 250K trap, the next question becomes, what mistakes should I avoid? Because as your business grows, small mistakes become expensive mistakes. In the next video, I'll walk you through the most common tax mistakes home care agency owners make, and more importantly, how to avoid them. And once you understand that, you'll be in a much stronger position to stay compliant and in control.